Generally, there are two types of properties, and they all fall within a spectrum of these. So on one side, you've got growth. So these are properties that are going to get better capital growth because they're more desirable properties and they appeal to the mass market. Let's say a house in Ponsonby, for example. Then on the flip side, you've got a yield property. So that might be something like an apartment. So you get a much higher rental return on the property, but you sacrifice a little bit of capital growth to get that higher yield. So a yield property will generally get a lesser capital growth because it's a more limited product or more specific product and only appeals to a certain amount of the market. Often a yield product might be something like a room by room rental, or it might be something like a dual key apartment that's not necessarily going to appeal to a home owner when you go to sell it again. And when you sell it later on, then investors are going to look at this product as an investment model, and so they have a yield in mind that they want to achieve. So their purchase price is based on what the cash flow of that property is. A normal house is generally purchased by someone with an emotional attachment to the house, and that's where people get higher values because actually there's no real mechanism or calculation for what that house is worth. Now, of course, not everything falls into these two categories, and again, they fall on a spectrum, but you do also get dogs or lemons. You can get a property that is neither good growth nor good income, and so you don't buy these as an investment. Sometimes if you're buying a really high growth property and you're not putting in any cash deposit, so you're borrowing 100%, you generally have what's called a negatively geared property. So something that's going to require some top up from you, i.e. the rental income doesn't cover all of the expenses. Now, as a rule of thumb, if you're buying a high capital growth property, I might expect a top up of between $20 and $50 a week, something like that. If, on the other hand, you're buying a yield property, something that you aren't getting the same capital growth, maybe a 2 or a 3% capital growth per annum, that would often attract a higher rental return. And so you might have a surplus left after you've paid all of your bills, and that might be $100 to $150 a week positive income. Over the long term, if you're looking to build wealth, capital growth properties are by far the better investment. So if you take, say again, a $500,000 investment that you're topping up by $20 or $50 a week, that's going to get significantly better growth, say 5% capital growth, so about $500,000 worth of growth over a 15-year period, compared to something that's high yielding, giving you an income now. But if it's a 2% capital growth rate, your net profit, so your growth plus your income that you receive, might only be closer to $200,000. So again, if you're looking for long-term wealth, it's a growth property. If you're looking for income now, it's a yield property. If we break it down to a weekly number, a growth property might be going up by, say, $500 a week, and it might be costing you $20 a week. So you've made $480 after you've put in your input. A yield property, on the other hand, might be generating $100 a week positive income, but might only go up by $200 a week in capital growth on average. So that's $300. So again, you're significantly better off with a growth property if you can afford to make that contribution. Remember, not all growth properties are negatively geared, and a big part of this depends on what interest rate you're paying. So right now, interest rates being below 3%, even if you factor in all of your costs, often there might not even be a top up at all. So it is important to get the mix right and to have a mix of properties in your portfolio. And the reason for that is any of us have got limited amounts of money that we can put in as deposits or as an ongoing contribution. So what you might like to do is build a portfolio where you get a couple of growth properties now, which might be topping up, say, $100 a week, and then you might look for a yield property next to help offset the cost of those growth properties. So you might have growth, yield, and that allows you to have a cash flow neutral portfolio, but not sacrifice on capital growth. What I think is important when you're starting out building a portfolio is to set the foundation on growth properties to begin with. And the reason this is important is because, as we've seen with the numbers, you get a much higher output long term with growth. Because we don't know when the bank might turn the tap off and not allow you to buy the next rental property, you want to make sure that you're not sacrificing that long-term wealth now. You start with maybe a growth property, followed by another growth property. Your top up might be, say, $70 a week for those. And then make your third property, for example, a yield property generating $100 a week to pay for those first two. And then you can repeat this process as many times as the bank will allow you. If someone's got a high disposable income, they might focus on more growth properties. So their model might be growth, 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 yield, or growth, 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 yield, because they've got the disposable income to afford that weekly or fortnightly top up to own those higher growth properties. Now, if someone's on a lower income, they might have to have fewer growth properties for every yield. So they might go growth, yield, so that they're generating an income because they can't afford that weekly top up that's required for a higher growth property. The reason it's important to have a formula is because otherwise you don't know what it is that you're looking for in an investment. So if you've got that planned out at the start, then you just need to find a house that matches that investment profile.